If you've ever wondered how national home builders get their land or how land developers actually make money before a single house goes up, this episode will be for you. Welcome back to the Passive Income Playbook on the Best Ever CRE Show. I'm your host, Pascal Wagner, and today we are joined by Brandon Cobb, a seasoned land developer whose firm supplies lots to some of the country's largest home builders. Brandon specializes in affordable housing communities and has carved out a niche in one of the most essential but often overlooked parts of the real estate development cycle: raw land acquisition and entitlement. If you want to understand how value is created before the vertical construction even begins, and why land development might be one of the highest leverage opportunities in today's market, this episode is packed with insight. And with that, I'd love to dive in. Welcome, Brandon.
Hey, man. It's great to see you. Thanks for having me.
Yeah, I'm excited to have you here. I'm excited to dive in. A lot to talk about. I would love, we're going to be double clicking on land development, the economics of it, what it looks like to invest from an LP perspective. But just so that everyone understands who they are learning from, give us a little bit of your backstory about how you got into land development and what your firm looks like today.
Yeah, so I'll keep it brief. It's funny. I am somebody that never, 8 years ago, had you said, hey, you're going to be inventing these new communities, I'd have looked at you like you had 9 heads. I tell people that all the time because it's true. I am not what you would call a natural entrepreneur. I don't see myself as that still to this day. I see myself more as an integrator, and my partner's like the visionary entrepreneur guy. Like, I like to be the one to organize everything and execute and make sure things go according to plan. And it all started when I was in medical device sales. So that actually was where I thought my life was going to go. That was my dream job. And just like a guy in his 20s, had been out of school for a couple of years, all I wanted to do at the time was get a nice, safe corporate career, make my parents proud, right? I finished college. I got the big job and I was doing really well. I had this career where I was in the hospital every single day, rubbing shoulders with successful orthopedic surgeons. I got to train hospital staff on my product. I felt like I was making a difference in the patient's life. That was important to me. I wanted to intrinsically be motivated, right? Making a big impact and a difference. And I felt I was doing that through medicine, through assisting the doctors and their technicians to help make the patient's life better. And let me tell you, a guy in his young 20s, wearing scrubs every single day, getting to do surgery stuff, I thought I was the coolest kid on the block. I had the coolest job in the world. I had made it, right? Like, this was my dream job. I had fought for years to break into. And then one sunny Friday afternoon at the Starbucks over in West End, I met my boss to tell him that I had had a phenomenal day as a sales rep. Like one of those days where you're telling your boss, like, dude, I made you a lot of money and I'm excited to tell you. And before I could tell him how great of a day that I had, he fires me.
Oh,
I'm gone. No job anymore. And I'll never forget how stunned I was that day because this was my dream job. And all I did as a single guy at the time was work. I loved what I did. And in those few moments, I realized that nobody was going to look out for my financial well-being but me. That was my big takeaway that day. You can work as hard as you want for a company. You can put the blood, sweat, and tears in, climb the corporate ladder, and at the end of the day, you're one restructuring or one economic event from not having a job. And so that is what forced me to get into entrepreneurship. Because remember, I'm not a natural entrepreneur, right? I didn't have like these big dreams. I thought I fit really well in this box. And that's what really started my real estate career. Luckily for me, I had some savings built up. I think my rent was 1/10 of my income. So I'd done a really good job of following in my parents' footsteps. Hey, don't spend money, save everything. I'd maxed out all my Roths, my HON, my HSAs, my self-directed accounts, my 401ks, like every single thing I was doing was to follow my parents' footsteps. And then I got let go and I tried a few things. I thought that I wanted to be the next Tony Robbins. So I started this life coaching business. And Pascal, you're not going to believe this, but there's not a lot of people that want to take life coaching advice from a 27-year-old.
Yeah, I get that.
So that business failed. I started an online motivational blog because I was really into all that stuff. Completely went under. I said, well, gosh, what am I good at? I'd done some stuff in medical device sales. I'd gotten in at a young age. Maybe I'll create a course on how to help people do that. That failed too. But then I discovered this vehicle called real estate. And at the time, I did my first real estate deal. I sold all my retirement accounts, paid the penalties. Don't do that, by the way. Don't do that stupid mistake. To start my business, I bought a house cash with that money, flipped it, made 30 grand, dumped all that money into marketing. That produced 3 or 4 more flips. And so I started flipping houses. And for 3 years, literally just recycled all the money back into it. Started building houses, and we were doing a lot of these spread out new builds, ran out of my own money and all my friends and family money. And that's when HBG Capital was born. And when we were able to take all of our own capital and pull it out of the houses that we were building and replace it with investor capital, that's when the magic really started, because we could invest in the business, we could invest in the infrastructure needed to grow. And we were getting ready to start doing some larger projects, right? Like, we've realized if we're spread out building all these onesie twosie houses, wouldn't it be easy if we could just build all in the same area, like 1 or 2 job sites that we show up, 30, 40 homes, and we've got a basket of pipeline homes that we can continuously do for a year or two. That was it. And we started doing that until we got a knock on the door one day. We had all the roads and everything in. The development was looking fresh. There was buzz in the air, excitement about these homes that were about to go up. And it was from a national home builder who said, hey, we really like this development. We want to buy it from you. And we said, well, too bad. It's not for sale. You can't have it. And they said, well, what if we offered you this for it? And we said, well, this means it's for sale. Yes, you can have it. And we got the one across the street we're about to develop. Do you want that one as well? And that's how we got into the land development business. It was by accident. We had a background as builders, and we've just realized that these national home builders, their cost basis to build is so much lower than ours, and they pass on that profit to us because they just want to get the ready to build land at whatever it takes to build their houses, because there's been a pretty big shortage over the past 2 of 5 years. No builders have bought anything. COVID, and then the interest rate hike, right? 2 of the 5 years it just froze. And so that's how we got into the land development business. Now we manage about $22 million per year in land development, and our strategy is the affordable housing sector, and I use the word little a affordable, not big A. Big A affordable is government Section 8 housing. We don't do that. We use little a affordable, which is that $2,000 to $2,500 per month mortgage. That's what the majority of your first-time home buyers can afford. And so we produce communities that are ready to build, mostly with national home builders that are catered towards those first-time home buyers.
Wow. Okay. That's quite a lead in. Okay. So give us a little bit more context of the firm today. So you mentioned that you do around 22 million in land development a year. What does that look like in terms of number of deals, maybe deals that have gone full cycle, if you've had any of those yet, team? Yeah.
Yeah. So, we've developed hundreds and hundreds of lots. And the thing with development is it's a unique term because it gets convoluted with builder. So when I use the word developer, I think of development, and development, I think of horizontal development. So that's flat, right? Build is vertical. And so what a lot of people don't realize is just about every neighborhood that you're in, everybody knows the builder, most likely, but they don't know who the developer is. And believe it or not, most of the time, land is developed and sold to the builder to build the homes, because the builder just wants to build houses. He doesn't want to do the grading and the roads and he just wants to build houses. He's good at that. And what most people don't realize is these national home builders are publicly traded company. They're owned by Wall Street, and they have to grow. And they need to hit a 20 to 25% IRR because they're using their own money, right? There's no debt. D.R. Horton's just putting its own money in and getting it out. They want to make 20, 25% on the homes that they build. And if they develop the land and have to put the money in that, well, that takes a longer time and it decreases their IRR because there's more time for the money. So they just want to get their money in and out as fast as possible. And they do that by just focusing on building homes. And so they will flip the land to a developer to develop it and sell them back the lot. So that's what we're talking about with land development. Now, in this category, there's two exit strategies that not a lot of people know about. And we utilize both of those. The first is something called entitlement. So, entitlement is just a fancy word for saying you get the land approved for development. And what I love about what we do, because I invest my money in multifamily, I've got my money in some commercial. Like, I love the tax benefits that come with that kind of stuff. And it's important to diversify. I'm a big fan of diversification. But what's different about this play with land is in multifamily or commercial, a lot of the times you're executing the value add portion after you own the asset. You buy the apartment, you renovate the units, you increase the rents, or you buy the commercial building and you renovate it. Here, we don't buy the land until it's approved for development. And so when we take farmland and get it approved for a new community, the value good does this. If you're listening to this, I'm pointing up. It goes way up. So we force appreciate the value of the land by getting it approved for a new community, and then we buy it. So we walk into a bunch of equity day one after we get the deal approved. That's kind of exit strategy number one. And a lot of times we're buying that land with 100% investor equity. We don't have a bank note on it. There's no risk. No one's calling the note due. And we can do something called land banking where we might hold it for a year or two and then sell it. Now, why would we want to do that? Now, we could just immediately sell it if we wanted to, because a lot of times we'll gauge builder interest to see if they want to buy some raw land. But if it's in an area where there's tons of development happening around this piece of land, if I just hold it for a year or two and I let all of that development finish, the area is so much more desirable and it force appreciates the value of the land even more. So that's exit strategy number one, is the entitlement play. And a lot of times we're not sticking a shovel in the ground. We're not doing anything. We just own the land outright with our investor partners. Now, the second exit strategy is what I was talking a little bit about earlier, is now we might go and introduce debt to it. So we go to a bank or a private source to get the debt financing. We have a contract in place with a AAA rated national home builder. So everybody knows Lennar and D.R. Horton and all these guys. They're putting down a significant deposit to actually do the development. So that's another kind of key that I'll talk about here when it comes to what limited partners want to look for, because we get free money from the builder to help out with the development costs. I don't know any other real estate business where I can get a 15% deposit from a national home builder for the purchase price, free money, interest free to do development, and it also secures their interest to the property. So we have it pre-sold before we ever raise any money or go to a bank and get debt. And so that's the exit strategy, where we're actually going in and putting the roads, the infrastructure, and that's the second layer of forced appreciation, is when you put the sewer and the water and the roads and everything. That's the second value add play. So we have, three different scenarios where we can force appreciate the value of the land. One is getting it approved for a new community. The second is just land banking it if it's in an area that's being developed. And the third is actually developing the land, putting the infrastructure in.
That's fascinating. Okay, so how does I'm trying to think through, how does that work, right? Like, so, I mean, that sounds pretty low risk of, like, I'm imagining the process of buying a home. So you go under contract or put an offer on a piece of land, just like you would a home. And then in the due diligence period, you are effectively going and getting that entitled throughout that process. And if you're not able to get it done in that due diligence period, then maybe you get your money back, or you do it before, your earnest money goes hard. Or is that how this process works?
Yeah. We don't buy anything unless the approvals are in place. That's when we actually close on the property. And so the conversation is very easy with the seller. hey, how much do you want for the land? Okay. And they've done some research and they're going to ask for more than they know it's worth. And we're going to say, okay, what if we offered you a little bit more than that? Would you be interested? Yeah. What do you mean? How are you going to do that? Well, here's how we're going to get to your number. We're going to go under contract with you and we're going to get your farm approved for a 100, 200 home community. And it's going to be worth a lot more now. I can actually go get the money to pay you what it's worth. So I'm going to force appreciate the value of your land. Here's the process. We're going to get the civil drawings designed and approved by the city, and then we're going to close on the property. And they are all ears when you're going to give them more money than they know their property is worth. And so it becomes a very easy conversation for them. So we do have to tell them like, hey, it's going to take, a year to 15 months to do this. Here's the process, but you're going to make a lot of money. And of course, there's council hearings and planning commission meetings that they can actually show up to so that they feel like there's progress being made. It's not like they're just sitting for a year wondering. And so that's a big added benefit. And the other is much like the architectural drawings from when you are building a home. That builder doesn't have a clue how much it's going to cost to build that home until it gets to architectural drawings. We aren't 100% sure of what it's going to cost to develop until we get our civil drawings approved. So the civil drawings show the grade of the property, the grade of the road, the sidewalks, how many bushes, the landscaping architect, put in there. So you need those civil drawings to be 100% sure about what it's going to cost to develop before you close on it. Now, again, like a builder's built so many of these houses before, he can probably kind of ballpark how much that house is going to cost, but not know for sure until the architectural restrictions are there. It's the same thing with land. Like if you've done these developments before, run your worst case scenario number before you start doing the entitlement process. And that's kind of what we use. But if something happens, if the market turns or we find something wrong with the property, we just cancel the contract and get our earnest money back.
So this sounds super interesting, right? So I'm thinking in my head, it sounds almost like no risk and there must be an immense amount of competition doing this if that's the case. But the value add or maybe the distinction is you have a way of maybe identifying property that is or land that is off market and negotiating with that seller or maybe there is a multiple bidding process and you're bidding more in that like what does that process look like in terms of like a value add and competitive nature?
Tell me more about that. I want to make sure I understand your question. What do you mean when you say value add and the competitive nature in the bidding?
Yeah, I mean, I'm okay. So I'm thinking I'm listening to this podcast, and I'm hearing that land. I can go basically bid on some land, and then have no risk in the deal, and then go reach out to the city and get it entitled. So, like, if it was that easy, I would imagine that there'd be immense competition of people doing that.
Yeah. So here's some of the bars that are in place. You reduce a lot of the risk by not buying it until the approvals are in place. I know some people that do that, and I think they're crazy. I would never do that unless you can turn around, have the whole project completely fail, and sell the land for at least what you got your money out of it, right? Because the land's worth something, even though it's not approved for a community. And in that case, that would be a good gamble. What's your downside, right? You're stuck with some land, you just turn around and sell it, right? But the big risk is the city not approving your project. And you eliminate that by putting an option on it. Now, why aren't more people doing it? Every business has poo-poo on it. This business, there's two poo-poo. Number one is dealing with the city. It is a pain. It is a slow, arduous process. You're dealing with elected officials that don't have a development background. They don't understand it. They just know that they want their community to be perfect. They don't even understand the bylaws sometimes that they have to abide by. Because you got to think these elected officials are usually older. They're usually kind of retired. They're most of the time older because they're looking to kind of give back to the community. The community. They see sitting on the council and planning commission is like something that they want to do to give back to the community because they don't get paid a lot of money. And so a lot of times you're dealing with very incompetent city officials that don't know what they're doing, unfortunately. And so that is a lot of brain damage because this is your baby and you're spending money on it and you're at the whim of these people that don't understand development or, your costs and stuff. So that it takes a long time for that reason. And you got to go back and forth, back and forth, back and forth. So that's number one. The second is the civil engineering. I'm just waiting for the day that AI replaces civil engineers. Oh my God, I'm going to look forward to that day because the civil engineering, designing those roads and the stormwater drainage, everything, it takes a long time. And, it is pretty pricey. You can have six figures in a project while it's under contract before you get it approved. And so it takes some money to be able to do that, right? The civil engineering is not cheap to do. You got to have the money to do it. So that's another bar that circumvent or prevents people from like just jumping in and doing this, right? And navigating these developments, that's why a lot of people will start out with smaller projects as like a builder and you kind of work your way up, right? You're like, okay, I did a 10 unit, had to put some sewer in a little bit. Oh, we had to do a road. Okay. And you just slowly extract that out because there's a lot of surprises if this is your first one and you're trying to do a 70 home community and you find out that the city wants a turning lane on the main road that's $800,000 at the very end of your entitlement process. Ask me how I know that. It can be very demoralizing. So there's definitely some nuances here when it comes to understanding what the risks are and what the headache is. But, luckily, AI is taking a lot of the guesswork out because you can now upload the bylaws of the municipality to, ChatGPT and then start asking it questions to figure some of these things out.
Wow. So there is just like maybe when you buy a house, you have it under contract, even though you have earnest money down and you might be able to get that earnest money back. You are doing inspections and maybe doing a sewer test and whatnot. And you do the same thing in land. And that is, I guess, quote unquote, the capital that you have at risk. So if you don't end up buying the property, you get your earnest money back, but you've still invested 50 or 100K or whatever the cost is. Maybe it depends on the size of the development based on the research you put in before it maybe gets approved or not.
Yeah, and what that looks like, so here's how to do it. One is while it's during due diligence, we go take it to our national home builders partner, and we already know that they're going to want it because we know what their buy box is, and we gauge interest. If we don't have any interest in it, we're not even going to finish our DD period. There's no point, right? The second is you want a environmental. So phase one environmental, all that does is test the land, make sure that no one's dumping any toxic sewage on it, or maybe there used to be a car wash that used a lot of chemicals, or maybe an oil change place, and they'll test the ground to make sure that, someone's not going to build a home on it and have the kids run around in the yard, get sick and sue. So your phase one environmental is one. The second is your geotech. The geotech tests the soils. I don't know about you, if you've ever tried to build a home on a beach, you got to have the pylons, right? You can't just go on top of the sand because that sand's just going to, wash that home away. You want to be able to build on good soils. So that geotech will tell you what the soil composition is and if you can build. It also tells you something else important, which is how much rock there is. And you want to know how much rock there is because rock equal expensive, right? So you want to know what that cost is. And then the third is an endangered species study. Now in Tennessee, knock on wood, we don't have a ton of endangered species up here, but Florida especially. I had a buddy that they almost got into trouble. They found some turtles on a property they were doing a self-storage development on. It's like 6 turtles. They were endangered. It's like a felony if you kill an endangered species. It's a very, very big deal. It was $50,000 to move those 6 turtles to an environment that they needed to go to. So if you're talking about as an LP and risks and stuff, show me the endangered species report. I want to see that there's no. Oh, my favorite one was I don't know if it was a mole or a gopher, but there was some endangered moles or gophers, something that digs holes underground. They had to hire a company to shoot specialized sonar to find them. And then they had to get specialized equipment that could dig them up, but without injuring them. And they had to dig all of these moles or gophers, I don't know what it was, on this like 50-acre property. And it was it was a six-figure bill. I don't know exactly what it was, but I heard that story and was like, oh my God. So we mitigate that risks by getting an endangered species study. Those are some of the things that we will do to the property, the land itself, to mitigate risk. So if you're thinking through this as an LP, it would be a good idea to take a look at those reports. And if they didn't do one, then that might be a little bit of a red flag.
And high level as maybe like land strategy, I'm imagining that there's maybe different types of land or strategies, and then we'll dive into the specific one that you do. But I'm imagining, we're expanding Las Vegas, and so you're buying desert, or I've looked at a couple of your projects. What it looks like is you're typically buying forests or what's covered in forests, and like what are like I imagine maybe, hey, there's a new. I mean, I don't know how often new cities are springing up, but like, hey, the city's trying to expand, or it just got a huge, a big company moving to the area, Fortune 500. And so, you're expecting population growth to go up. And so you're buying a neighboring land to build a community. Is that like the right strategy? Like, what are the general strategies, plays that land developers have?
Yeah, there's a lot, and I might not know all of them, but so you got to think about it like this. Every single piece of real estate out there starts with the land. He who controls the land controls the deal. So any real estate strategy that exists, there is a land strategy that's attached to it. You got to have the land if it's not pre-existing. So there's a program I've heard of called Land Geek, where they specialize in these parcels that are kind of out in the middle of nowhere. And you reach out to them and you buy them on terms, and then you flip that land on terms to a buyer. And typically the buyers of these parcels that are kind of out in the middle of nowhere, and I think it's like Las Vegas, Nevada, is a very popular place for this. It's for doomsday preppers, truckers, like somebody that just wants to be able to kind of go out and get away if it ever hits the fan. They want their own parcel. So that's a popular strategy. I know somebody that does that. I know people that just focus on subdivides. They see a piece of land and they're like, it's like on a corner a lot of the times. And so there's a lot of road frontage. So they're hunting areas with road frontage, and they're just dividing it up into, lots and selling those lots and making a profit. So I know that's a very popular strategy. I know people who flip land. So it's a strategy where they're going after specific rural parcels that kind of, again, meet that buyer demographic of like the prepper, the doomsday prepper, the hunter, the someone who wants to get away. That's a very popular one. I know that just chasing zoning approvals. So there was an area in Nashville. My buddy Greg, he capitalized on this. He bought a piece of land for $1 million and sold it for $3.9 million 2 years later. Because as soon as the city announced this new zoning for this area, I mean, he was on it, right? Like the day of, he was setting up a marketing plan and going after people. And what the city had done is they wanted to see development here because it was a pretty bad area of town. And it's not too far from downtown, and it was a main corridor. And so they made everything like RM20, where you could put like 20 units an acre on, like apartments. And all of a sudden that land was worth a lot of money, and a lot of the owners didn't even know it. And so a lot of investors were able to capitalize on that before the owners knew that the zoning had changed. And so you can just chase zoning approvals like that and knock it out of the park. I already mentioned we do the land banking thing, hunting parcels, putting money into it and just holding it for a couple years and letting it develop all around it. Or maybe there's like you said, a big thing coming, I don't know, a business. Amazon moved to Nashville, built a 5,000 C-suite executive, downtown. They needed homes, right? That created demand for a lot of homes in the affluent area of Nashville. So you can do that strategy. You can do like what we do a lot of times, develop the land and sell to builders. So there's so many strategies that you can do. You can get land rezoned if you want to change the zoning yourself from residential to commercial. You've probably driven along some roads where you're like, that's a residential house, but it's kind of around all the commercial stuff. You can probably get that rezoned to commercial. So there are so many strategies and they all work when it comes to land. And the funny thing is it's often overlooked because the sexy thing is like flipping houses and single family rentals and multifamily. And, like that's like the culture, the pop culture type of thing that everybody likes. So land often goes overlooked.
Yeah, I'm getting that. One of the things that comes to mind is, I've been studying up quite a bit on opportunity zones. Is this in any way related to opportunity zones, or are those not a factor in land?
That's a great question. I've never done a deal in an opportunity zone, so I couldn't speak to it. But if the land is in an opportunity zone, why wouldn't it qualify for the same benefits that a home that is right next door in the same opportunity zone qualify? You just need to build the home, right?
Sure. Okay, helpful. Okay, so now we have like an overview, a lay of the land, let's say here. And I want to double click on your strategy. So can you kind of walk us through maybe how your strategy, maybe if that's shifted at all, and maybe what goes into your buy box?
Yeah, buy box, it's definitely targeted towards the area for those entry level home buyers. So the first time home buyer is 100% who we market to. Now, I've got some luxury lots that, we're developing as well for somebody who owns a lot of land. They have a family office and we've kind of partnered with them and they just want us to turn the land into more valuable land and sell it using our builder relationship. So we've done some of that kind of stuff, but the entitlement stuff is really where we can scale a lot. We love the entitlement stuff. We can find and line a builder up in the initial stages of it. Kind of how our strategy has shifted is we're focused on bigger deals. It takes just as much time and effort to go after a piece of land that you can do 50 units on as one that you can do 300-400 units. And so really where we're changing gears is we're trying to do more partnerships. So we used to just do everything in house. We raised all of our own money. We were vertically integrated, did all of our own deals. We've realized that in order for us to scale and get to 100 million a year, we're going to have to do more partnerships. We're going to have to bring more people to the table, give them a bigger cut of the pie, bring some other outside developers in who've, got all the equipment and stuff to kind of, do it themselves and focus on bigger deals. I want to go after deals where we're at that parcel of land for 4-5 years. Because in development, especially when you're developing lots, what I love about it is every time you complete a phase, so you develop it and homes are built, that second phase is more valuable than the first. And then when you do the second phase and you're doing the third phase is even more valuable. And the fourth is even more valuable. So your deal is force appreciating itself as you complete each of the phases and make them more and more valuable. So that's one of the other things that we're really focused on, because when you can buy a 300 unit piece of land approved, good to go, for the price of your first phase, you're going to kill it on that third, fourth, fifth, sixth phase. I mean, that's where you can really start knocking it out of the park.
Okay, and now give me an idea of, as an LP investor investing in these types of deals, what is the hold time? What is a, in multifamily, you might have a 15 to 20% IRR and a 5 to 8% cash on cash return projection.
Mm-hmm.
What is what does that look like in the world of maybe your specific strategy? As I'm assuming like, all these different strategies have different hold times and projections.
Yeah, that's a great question. So, a lot of times when, let's say we just land bank it, for example, 100% equity, there's no debt on it, we're just holding it with investors. We're typically doing preferred returns in like the low double digits, 12 to 15%. And so we own it outright with our investor partners. We're going to sit on it for a year or two, and then we're going to sell it. If we're introducing debt to the deal, we are shooting for an 18% preferred return. So we don't do any of these fancy waterfalls and GP cuts. We just said 100% of the money is going to go to the investors until they hit their 18% pref, and then they're out of the deal. And that allows us to capitalize on the future income that comes in from that. And so that's kind of how we're set up. As far as loan to values, this is where it gets really interesting. So you might underwrite it. I remember when a lot of multifamily deals were like 82, 83, 84, 85%, loan to value. In the development world, a lot of it is based on loan to cost. So especially now, since we've had the interest rate rise, a lot of people don't want to use LTV because the values have adjusted due to the interest rates, right? And so a lot of times you'll see that you'll have a lender say, hey, I'll give you a 65% loan to cost. So you're going to come up with another 35% in order to be able to execute on that project. What that does is you have these very low loan to costs. So we typically want to see a 25% reduction in the value of the land, the property, before we get to like a break even number. And sometimes it can be even more than that, but that's usually what we aim for. Now, what's really interesting is sometimes we're achieving these like 40% LTVs. Why is that? It's because the builder, and you're not going to get this with a local builder, right? This is where Wall Street funded buyers really comes in handy. I've got a deal right now that we're working on getting the approvals. Well, DR Horton's come in and they said, hey, we're going to give you a $1.1 million deposit. And that's not held in escrow. That is released towards the development cost. Free money, no interest at all on the deal. And it cost me about $4 million to do that development portion of it. So I'm getting 25% of my cost from that builder. That helps out significantly. And so what does that do exactly? So we do secure them with a deed of trust behind the bank loan, right? They want their money secured to the property, but it lowers the amount of capital that I need to go get. Because if I'm 65% loan to cost, well, 65% of that 4 million, let's call it somewhere in the ballpark of what, 2.6, 2.7, I'm getting that from the bank. I'm getting another 1.1 from the builder. So I'm all in at what, 3.6, 3.7 right now. I need 4 million, plus the soft cost of the project. I don't have to go get a ton of capital from the investors, and my loan to value is very low. So that's a big advantage.
For all of us, can you kind of break down the difference between loan to value and loan to cost?
Yeah, loan to value would be if I've got a home that's worth, or a piece of land that's worth $1 million. A lot of the times the banks will lend on loan to value, especially if there's if there's good proof that it's worth that. This works really well in the home world because they can point to homes that have sold and be like, all right, great. Builders will get, I remember in the heydays, they were getting 90% loan to value. They were getting a very high loan to value for their construction costs and not having to come out of pocket any money on the debt. It was basically 100% financing for their build, no money out of pocket to them. And then you had the rate hike and all that changed. But loan to value is where you lend based on the value of the land or value of the home. And in land, it's a little bit more common to lend on the cost because the value can be so subjective. And so one of the downsides of investing in land, especially development, what we do is there's not as many buyers out there. So you got to be very good at knowing what your end buyer wants, because there's not many builders that can take down, 50, 60 lots. You know what I mean? That's a risk. So you got to really know and have your builder locked up in the deal before you execute on everything, and have an exit strategy if it doesn't work. So let's say, for example, I've got a piece of land that's worth $1,000,000 and the bank's going to offer 70% loan to value. They're going to give me $700,000 on that piece of land, right? But let's say that it's the same piece of land, it's worth $1,000,000, but the bank says, no, we're going to do a loan to cost loan on this. And it's 65% of whatever it cost you. And let's say for simplicity purposes, it cost me $500,000 to do that development to get it to be worth $1,000,000. 65% of 500,000, that's what? Probably somewhere around 600 and what is that? $300,000, something like that. So they'll say, I'll give you a max of $300,000 for this, and I got to go come up with the other portion to finish the construction cost. So most of the time, you want to get a loan based on the value of it, preferably, because you're going to get more. But in this case, especially if you're working with banks, they're probably going to lend on a loan to cost type of loan structure. We like to use private sources for the debt because they understand this strategy, and there's lenders out there that specialize in this, and so you'll get better terms from them. And I'm a big fan of getting the terms you want on these types of deals, but you're going to pay a little bit more for the money.
Yeah. Okay, very helpful. So essentially, loan to cost is just another tool that banks use in order to determine how much to give you as a developer.
Yeah.
Yeah. And now I would love to maybe understand, before we were talking a little bit about deals that have gone sideways. I love to talk about the highs and the lows. I'd love to start out with a, incredible success story, maybe a case study of yours, and then we can dive into the risks and what like a poor deal looks like.
Yeah. If I could just do these types of deals all day, I would do this deal. We had a deal on Old Nashville Highway where it was an entitlement deal. So we got it under contract during our due diligence. Big builder wanted it and said, hey, I think we were under contract for like 18,000 a pad, not 20,000 a pad maybe. And they wanted to buy it for 38 a pad. And we got it approved for 43 townhomes. And so we're like, great. They put the money down. We got them locked up. We got it approved. They bought it. We made $500,000 in less than 12 months. Not a ton of risk involved. The seller was super happy because it happened to be in their primary residence. And so they didn't pay any capital gains tax on it because it was their primary residence, that piece of land. So they got $900,000 for a house that was worth maybe $250,000. I mean, it was a no-brainer. So that's what I'm talking about, adding value to the seller. We are force appreciating their land significantly. So that was easy peasy money, man. If I could just do 20 of those deals a year, I'd be really, really good. So that's one that we did last year that worked out really well.
Tell us about one that goes sideways.
Yeah. So back in my paying the dumb tax days when I didn't know what I did today, we bought a piece of land that we got approved for 10 townhomes. So we did our thing. We got the approval, right? What we didn't do was we got the approval. So there's something called a preliminary plat approval. That means the city has blessed the development, said, yes, we will allow this development. But now you have to get the civil drawings created and approved by the city to finish it out, basically, right? So we hired a bad civil engineer that did a very poor job of designing it, and 30% of the way through construction ran into all these problems. Problem after problem. We had to go back and redesign it. Took us a year. We went through redesign after redesign because we realized how much it was going to cost. And we were like, holy crap. We ended up having to put a $500,000 retaining wall in this development that originally had a $50,000 retaining wall.
Ouch.
I don't know if you've ever seen a $500,000 retain. It's like the Great Wall of CMU block. I mean, it's huge. It's like 20 feet tall, 200 feet long. It's enormous. I lost $800,000 on that deal because I did not follow the golden rule, which is don't buy anything until you have all the approvals, all your civil drawings done and designed. That was the hard lesson learned on that one. So that's why I'm a big advocate of putting it under contract, getting all the approvals and everything designed first, and then closing on it and moving forward.
I'd love to dovetail this into my next question, but I wanted to highlight, I think it's, I applaud you for talking about these because I think I want to invest with people where you can tell that they've learned, that there's clearly that they're optimizing and getting better over time. And it's clear to me now that you're going through that process. What are other, I imagine that your first deal looks totally different than the deals you do today. How has that changed over time? I mean, you just mentioned one of those that you make sure that you have some of these pieces in place. Are there others?
Oh, yeah. So we had a deal. I mean, we still did really well on this one, but I'll give you an example of another thing. So we bought a deal that was approved for 36 homes, I believe. And I mean, it was ready to go. We're like, oh, dude, this is great. We'll build 36 houses on this. Well, when we got into it, the width of the lots was 30 feet and the setbacks had 5-foot setbacks on each side. In other words, you had to have 5 feet from each of the homes. And what that did is it shrunk the width of the house to 20 feet. Well, it turns out it's very difficult to build a house that's 20 feet wide, especially in the market that we're in. So again, this was when we were learning and we didn't know anything about that. And we're like, oh, crap. So we had to go back and we lost 6 lots. So we got it designed for 30. That pushed the width out to where we could fit a 30-foot wide home, which is kind of the minimum size home that like national home builders, what people don't realize is they have products. So they want to build the same home over and over and over again because they have whole teams that go in and design these houses to reduce the number of nails, to reduce the number of lumber, to like these homes are designed for cost efficiency. They have whole teams working on them and they want to build that home. So that home needs to fit on every single one of your lots. We didn't know that at the time. And so that was another learning experience. So once you know what the footprint is of the houses and the setbacks, and all setbacks are is how far does the home need to be from the street? How far does it need to be to the back of the property line? How far does that home need to be from the left and right side of the property line? You want to make sure that product fits on that lot. That's an example of another thing that we learned that somebody new may not know about.
So these bring up great points, right? Like as an LP investor, I've been interested in investing in land. And I think one of the big things that's held me back is just not having a good fundamental understanding of all the different strategies. How can things go wrong? And, I think it's clear in talking to you from your experience, like I can tell that you are experienced because you've had things go sideways. You've had to learn, right? How does an LP really, when they're looking at different land operators, maybe they're looking at investing with you or they're comparing you to others, what are good questions we can ask or what should we be looking for to really understand if you know your stuff?
Yeah, that's a great question. And the answers are probably not going to surprise your listeners. There's 2 big risks. That's the operator, the person you're investing with, and it's the deal itself. That's it. That's what it boils down to. So how do you do the due diligence on those 2 things, right? Well, in land, what I've kind of already mentioned is it approved? Is it approved? Or are you going to have to, take it through that approval process? Did you buy it before that approval process was in place? So that's number one. You want the approvals in place and you want to see some kind of proof of value, right? All right, Brandon, you say it's worth this. How do I know that? So you want verification that the home and the value and the equity is there, right? That's number one for sure. That
That's
has
a
to do
good
with the
one.
land. You can go into those reports that I talked about, the geotech report, the phase one environmental, and the endangered species reports. Just ask if they've got those. That means they've done a lot of the due diligence on it. And that eliminates a lot of the risk with the deal itself, right? If you see that the value's there, if you see that they've got, the civil drawings and they've got bids on it and they know what it's going to cost to develop, they've done their homework, that really eliminates a lot of risk on just the deal. The sponsor is another thing. Like I recommend running background checks on people. I give away my social security number if they want to run background checks on me. I'm fine with that. Like, I'm surprised by how few people do that. I run background checks on anybody that I'm doing business with, period, because it's such a low cost for such a high potential return. And I've never been burned by anybody. Luckily, I've never had a bad report, but it's a safety measure, right? So that's one thing you can do. The other is getting a gut feeling for somebody. This is one of my things. I like to have as many calls and interactions with people as possible before doing business to just get a gut feeling about them. And there's something about your gut, man. It sniffs out if there's some BS anywhere. So I'm a big fan of doing that. Like even on Zoom calls, like what we're doing right now, just talking and hanging out, just getting a feel for the person. So I'm an LP in other people's deals. So I invest just like the LPs do. That's one thing that I like to do. The other is, and this is no surprise, track record, but where I think a lot of people fall short is verifying that track record. I think a lot of LPs over the last 2 years have realized that the multifamily deals that they invested in that got caught in the middle of all the bridge debt and are now in foreclosure or whatever, they realized that they weren't investing with the person running the show. They were investing in a fund of funds model where all the person was they were giving the money to was just raising capital for that multifamily deal. They weren't running the show. They didn't have control over the asset. So who are you giving your money to? Is it the person that actually has control over that deal, or are they just a capital raising partner in it? Like we own the land. Brandon owns the land. Brandon is the fund manager. We're not co-GPs in a deal. We are God of the money. We are God of the development. We make all the investing decisions. So I think a lot of people, a lot of LPs go wrong there. They vet the person's track record, but were they actually the ones doing all those deals or not? Yeah, So that's I wanted to provide that context because I don't want to just give an answer that's verify their track record, because I'm sure that's what everybody says. That would be the big nuance with that. So when you're vetting the operator, track record, yes, but let's verify that track record and see if it was actually them or if they're just, raising capital into a deal. And if you can invest with somebody that has a stellar track record, they've done this time and time and time again, that's going to eliminate a lot of the risk right there.
Yeah, I think about it as ideally full cycle deals. How many deals have you taken full cycle? What is, I think we're in 2025. What is changing in the demand profile of buyers of these communities? I'm imagining that what DR Horton or I don't know the list of buyers, but I imagine that their criteria potentially shifts over time. Is that accurate, or do I have that wrong?
Yeah, it depends. So the demand itself, broadly speaking, holistically, big picture, is only growing. Because last time I checked, the population's still growing. It's not shrinking, at least in America. I've heard some crazy stuff about China and Japan and the one-child policy, but we're growing here, which means you have humans, which means you need housing. So that's not going away anytime soon. And what's interesting is the way I see it is it's like a box that has these balloons being blown up. And at one point, the air keeps being forced into all these balloons in this closed environment, and one's going to pop and they're all going to shift. And so that's kind of what's been happening over the last 5 years. So let's talk about one of those. It all boils down into supply and demand, right? There was so much demand, especially for these entry level homes, right? So that in itself is going to have different supply and demand characteristics than like the luxury home market. So it depends on what area you're talking about, but I'm just going to speak to just housing in general for a second. The last 2 of the 5 years, no builders bought anything. That was 2020 COVID. And then, 2022, 2023, when the interest rates went up and everyone was freaking out, wondering what was going to happen. So nobody bought anything, 40% of the time the last 5 years. That's a lot of catch up in and of itself. And if you go to the Freddie Mac data for fun and just go look at new construction housing starts in the United States since the 70s, you'll see these ebbs and flows. And it actually shows you the periods where you had these housing busts because the new starts was like crazy high. I mean, you can just pinpoint it, right? And if you look at what happened in 2008, I mean, it went to zero almost. And if you look at the trajectory, it goes up, but it does not recover. We still haven't recovered from that 2008, 2009 collapse. Builders just haven't been able to catch up with the housing demand. So that's a couple balloons you have in the box. The other's interest rates, right? So you got the interest rate balloon that's being blown up, and it was low for a while. And so you had a bunch of air being shoveled into it, and it was, moving the other balloons in the box. And then all of a sudden it popped in 2022 and everything shifted, right? And oh my gosh, you've got price sticker shock because in the matter of 8 months, your mortgage almost doubled. Well, that's going to take some time for the consumer to realize, oh, I can't shop for a $500,000 home now. I'm shopping for a $350,000 house. And so that took some time, right? That definitely decreased, some of the demand you're seeing. But the fundamentals are still there. We're still short the houses we need. You have 33% of the home buying population, millennials, first-time home buyers. They're in their mid-30s, having families. They want to buy a house and settle down. They're chasing 10% of the inventory that's entering the market. 10% of homes being built have that $2,500 or less mortgage. Huge supply and demand imbalance. If you throw the other fact into this, that over 40% of homes have a mortgage rate that's less than 4.5%, do you think that they're going to put their home on the market anytime soon for a 6.5% interest rate? Heck no, they're holding on to their house for dear life going, oh my God, if I sell this thing, I'm going to have to, like, my monthly payments going up. So that's keeping a lot of supply off the market. So you've got a lot of these forces that are battling it out, pushing each other in this, closed box. And it's been very volatile, especially over the last 5 years, just with the crazy COVID, the supply chain issues. Then you had the interest rate hike and all that kind of stuff. But the underlying big theme is you still need houses. That need is not going to go away.
So I find that looking at these trends, like you mentioned, this happens every cycle where there's massive oversupply in building, and then it kind of drops, and then then it slowly picks back up, and it's usually like right now. There was a lot of supply, a lot of developments, and all of that supply is hitting the market, and so we're hearing in a lot of places that there's a lot of supply coming on the market. Rents are getting suppressed. They're giving a lot more concessions, and there's not many new housing starts. And I imagine in the next 3 or 4 years that once that inventory gets absorbed, just like every other cycle, that we'll go through this process where it makes sense to start buying and building again. Do you see that same trend happening in terms of interest and buyers in land?
Yeah, the national home builders are full steam ahead. Now, they're not doing the crazy stuff they did before interest rate hike, like the euphoria kind of stuff. Like that's gone. But they here's the thing. These are publicly traded companies. They have to feed the machine. They have to buy, or they don't grow. And if they don't, the stock goes down and people sell and the shareholders get hurt. So the people in charge of buying, making the decisions to purchase these lands, they're incentivized to buy the land. They have to, or they go out of business. So that's not going away at all. And I can say that, the market's softened a lot since the interest rate rise, but they're still buying, especially in areas where they have existing communities and they're looking for their next community. They're not in massive expansion. So if there's a new area, they're more hesitant to go into that area. But again, they have to buy because they're not buying for what's going on today. And they know this. They're buying for, 2 years down the road, because that's how long it's going to take to build and sell these. So they're skating where the puck is going, not where the puck is right now. And right now, they can't buy enough land fast enough because, again, they didn't buy anything the last 5 years. They're still playing catch up. That's what we're seeing in the Nashville market, at least.
Yeah. Brandon, this has been incredibly informational. Where can people learn more about you, your opportunities, and find you online?
Yeah, so my name's Brandon Cobb. I'm on LinkedIn. I'm on Facebook. But we've got two areas where we can help people. Number one, if you're an LP, you're an investor, and you're looking to diversify into land, and maybe you like some of the stuff that we said, you want to learn more, you can go to our website, hbgcapital.net. It's pronounced Harry Bob Gary Capital.net. If you're trying to, make a big impact, build a legacy, create the passive income, we've got a free ebook on the website called 100 Questions Business Owners Ask Before Investing. I wrote that book because I had an investor call me who lost all of his money on a real estate deal that he lent money to. And on that call, it became very clear the reason he lost all his money is because he was very green. And like you and I talked about, he did not know how to vet the sponsor or the operator. And as a result, he lost all of his money. And I left that call thinking, if I could just prevent that from happening to one other person, how could I do that? And so I put that book together because I believe that questions unlock the answers we need to make more informed investing decisions. If you can ask the right questions, you get the right answers. And I'm confident he wouldn't have lost his money had he had that ebook. So that's the first way. You can go to hbgcapital.net, grab it. It's free. The other is if you're wanting to be an active investor, if you're wanting to do what I do, if you want to learn how to do entitlement, if you want to learn how to do land projects, you can go to learnlanddevelopment.com. That's learnlanddevelopment.com. We've got a free course on there, land development one-on-one. You can check it out. It's completely free to get you started. And, if you want to learn, listen to more of our stuff, we've got a show called the Recession Resistant Real Estate Radio that I think you're going to be on as well. And we're going to interview you.
I love it. I love it. Brandon, this was great. Thank you so much for joining us. And for all of those listening, if you want access to more real estate deals, maybe similar to the ones Brandon is putting together, you can always grab my Passive Investing Starter Kit at passiveinvestingstarterkit.com. It's one of the best ways to see as many 506C opportunities that I've aggregated over the last couple of years and help you find more deals. And so thank you again for joining us here on the Passive Income Playbook, part of the Best Ever CRE show. We drop new episodes every Thursday, so be sure to tune in each week for more conversations, strategies, and stories to help you grow as a passive investor. As always, if you enjoyed today's episode, we'd love for you to subscribe and leave us a review, as those help us reach more investors like you. And just thanks again for tuning in. We'll see you next week for another episode of the Passive Income Playbook.